Hi, and welcome to Policy Loan Provisions. I'm your friend, Frankie Guzman from Valley Village, California. I want you to understand that policies come in three parts. The first part is options, and these are choices you have, or even the beneficiary have upon your death, to receive a sum of money distributed to the family. Riders. Riders are extra bells and whistles that you can add to your policy for extra money. And provisions. Provisions is that negative four-font information you find inside a policy, you know, all that legal mumbo-jumbo? Yeah, everything you find inside a policy. But more specifically, they're the rights and characteristics of your policy that have to be in there to protect you, the consumer. So let me give you an example. Again, it's policy loan provision. And the policy loan provision is found in permanent insurance. Now, when you've had your permanent insurance for an average of 3 years, it could be longer, it could be anywhere from 3 to 5 years, but the average is 3 years, your policy starts to build something called cash value. Now, you've been calling the cash value a savings account up to now, but I want you to make sure you're clear, because we're going to define it now, as a cash accumulation you can borrow at a later time. Okay? So as the owner of this policy, you're allowed to borrow money from the cash value once it starts to accumulate. Now, you won't be able to borrow all the money, just a large portion of it, and usually it's up to 90% of the cash value. Now, when you borrow money, what do you got to do? You got to pay it back. The cash value was growing at what you think about an average 4%, but when you borrow money and you start to repay it, it's going to be repaid back at an average of about 8%. If you do not repay this loan, the company considers it an advancement of the proceeds to the family. So upon your death, by not paying any of this loan back, they'll take what you borrowed and any accrued interest and give your family the difference. Now, built into this policy is a little feature to help protect you, the consumer or the policy owner, from accidentally lapsing the policy. Okay? It's called the automatic premium loan. Again, it protects you in case you don't make the premium payment within that 30-day grace period. Okay? And what's going to happen, the insurance company is going to borrow any available cash value from the policy to pay for that premium. Okay? Now, are you borrowing money? The answer is yes. They're borrowing it in your behalf, so you'll need to repay it. Again, if you don't repay this loan, when you die, the insurance company is going to take away what you borrowed and all the accrued interest and give the proceed, the difference of those proceeds to your family. So I hope this information helped you understand the policy loan provision, and I thank you for your time.